Hello folks, it is Sunday evening. In this video, I will focus on interest rates and the macro trends that I believe are affecting interest rates, which of course also spills over into the equity markets. So let's jump right into it. We are looking at a monthly chart of the yield on the one-year Treasury bill. Remember that 12 months and less, government instruments are considered same as cash. So we can think about this chart as it's kind of representative of U.S. cash. But what jumped into my mind when I was looking at this chart is that when we see vertical movements in this instrument, we don't have good things going on in the economy. I mean, that was the financial crisis. There's the big scary plunge, March of 2020, and we don't know exactly what's going on right now, but we've got another vertical movement going on. And as I just said, based on this chart, when this vehicle goes vertical, it's not a good thing. Let's consider what's up with markets. That's me. This just my opinion, folks, and just spitballing some of the stuff that I believe is going on in the markets right now. Investors are acknowledging and reacting to the idea that inflation is not transient. We're in the midst of an inflationary cycle, and it's going to be persistent inflation. And I think that's a big part of what's going on right now is that consumers and investors are deciding how to respond to inflation right now. We've certainly got the Evergrande debt collapse, which of course has fallen out of the news unless you dig for it, but that's still going on in the background. One of the aspects of that situation is that Chinese debt holders are being made good to some extent, while China's thumbing their nose at foreigners on the debt situation. So that's not a good thing if you're exposed to debt in Evergrande or any of the other Chinese real estate developers. There are some people who believe that this Evergrande bond collapse was the canary in the coal mine for the global bond market. And if you look at history, back in the 30s, the economic turmoil started with the collapse of the bond market. It was not the stock markets. So the global debt situation is something to keep in mind. The Turkish debt and currency situation could be attributed to the Evergrande collapse, as possibly the Lebanese situation as well. We have to acknowledge that China has been making heavy investments in Kazakhstan for at least the last 8 years. This was a key part of their Belt and Road initiative. Kazakhstan is a unique geographically, it's China's gateway to Europe. And I put just a quick map to show that. So here's China, here's Kazakhstan, here's Europe. And so China was making major investments throughout Kazakhstan as the gateway to Europe and the markets there. So easy to dismiss, but there has been a significant revolution in Kazakhstan. The economic situation there has changed. And so we don't know exactly how that will affect China, but there will be an effect. Evidently, the destruction is fairly extensive. So anyway, several things going on related to potential debt collapse at a global level. Geopolitical factors, this is the situation that the only people that see this happening reside in Washington, D.C. So anyway, that's an interesting situation. If we look at China, there is a lot going on. So we've got this collapse of the real estate developers. And one of the factors there is the Chinese people invest in real estate, and what they invest in is brand new condos. And of course, you can't let anybody live in a brand new condo, or then it's not brand new anymore. And so evidently there are 70 million vacant investment condos in China. in the midst of a real estate collapse. And what do you do with that many vacant condos? Many of them are unfinished. That's another unique aspect of Chinese real estate market, is that typically homes and condos are sold unfinished. They don't have toilets and sinks, etc. That's done after the fact. So 70 million vacant condos, and some amount of them are unfinished. Olympics ongoing. Just based on the reception of the opening ceremony, people are not interested in the Chinese Olympics. China is starting to ease economically in the face of the rest of the world tightening. And I see this as an indication that China is not doing well economically. The fact that they are easing as the rest of the world at least threatens to tighten. Some people believe that China is closing their borders to the rest of the world, that basically they have decided that globalization is not beneficial to them any longer, and they're making other plans. So Belt and Road Initiative possibly collapsing. They're certainly having some challenges there. Unfortunately, one of the things that governments do when they get into economic challenges is they look for distractions. And that can look like many different things, and we don't know what exactly they might look like. All we know is that based on history, when governments get into economic stress, they have a tendency to look for distractions. So some of the narratives going on that could be coming into question in the background, the idea that the U.S. Fed is omnipotent. If anybody believes that at this point, they may be becoming disabused of that idea. The idea that inflation is transitory, I think we can give up on that idea. And people are starting to question, I believe, whether some of the stuff that's going on globally is actually worth the economic turmoil and impact they are causing. I mean, we can look at events in Canada, along the borders. Italy, I think, has had some activity over the weekend. Anyway, any number of narratives that are coming into question. So a lot of stuff going on in the background that could be affecting interest rates and other financial markets. Let's take a quick stroll through the charts. This is the 1-year bill. We looked at it in the monthly time frame. This is the daily time frame. Big impulsive movement. We can see markets are open now. That's what it's doing today or this evening. It's Sunday evening again. 2-year Treasury note. I had drawn this. So Dr. Timothy Morge, one of the advanced charting techniques that he taught, he called it double the range. And so basically when you had a vehicle in a trading range, and that's what we have in this vehicle here, it's this slanted trading range. When a vehicle breaks out of that first range, there's a fair probability that it will double that range and reach the doubling point as a target. And so that was what I was depicting in this chart probably 2 weeks ago. I did not expect the double the range target to be hit so quickly. Again, big impulsive move, actually surpassed the double the range target. And so I expanded. You can see that was 1.45, and we're at, almost 1.6. And so I did the same trick again. You can see we take the width of the first range, duplicate that line, make the second range, duplicate it again, there's the third range. And so when we triple the range, we get this target up here at 1.8%. That's the ellipse there. MACD obviously overbought, but headed higher. Energy remains elevated. 5-year note, same thing, heading higher. TNX, this is the 10-year note. This is the chart that we look at more frequently. We're looking at the weekly time frame here. We can see that we've had a test of the 2% range, big spike. We're pulling back and dealing with that overhead resistance. Notice that the yield has risen above this median line. That's the lower median line of this Andrews pitchfork, and at least today is holding above that level as support. MACD in bull mode on a buy signal, energy very elevated, all suggestive that interest rates are heading higher. This is the 10-year in the daily time frame. Big impulsive moves, two big impulsive movements, kind of waffling sideways today, digesting, I would say, digesting these big moves. MACD very overbought, energy very elevated. 30-year note, or actually this is a bond, 30 years, that's not a note. Sorry about that, folks. That would be a bond. And pushing higher, let's zoom in on this Andrews pitchfork here. So looks to me like we're going to run up here and make a challenge on this 2.45 level. This is we can see this is double the range again. Here's our original range. Now we're broken higher, so we double the range. That gives us this target at the pink line. Coincidentally, we've got this overhead resistance zone from the prior high, and no reason to think that we're not going to see a test of that level. MACD in bull mode on a buy signal, energy very elevated. Interest rates are starting to affect mortgage rates. Here we are at 4.6, and so rising interest rates definitely affect mortgage costs, which plays into real estate markets, obviously. It doesn't take much of a rise in mortgage rates to affect affordability of housing. We've looked at this inflation rate, 7.5%. If we look at John Williams' site, he's showing 14.8%, I believe, right now. All right, folks, I'm closing it up here. Have a fantastic week. Talk to you soon.